Hello, everybody. Welcome to Financial Statement Ratios. This is part 6, Other Considerations, and this one is going to be talking about stock compensation expense. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including, but not limited to, Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2022 by Bennett Tchaikovsky. Note that the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. The other parties are the owners of their respective copyrights. Okay. When a company grants a stock option to an employee post 2006, they were required to record an expense. Let's think about this. So I'm giving an employee an option to buy stock, meaning that they're going to have to pay me cash, and I have to go through and record an expense that reflects that. Think about it. Is when I think of an expense, is this something that I'm actually paying out cash for? The answer is no. So when stock compensation expense is recorded, the entry that happens that will be done is going to be a debit to stock compensation expense, and there's going to be a credit to additional paid-in capital common stock. This is a part of owner's equity. What happens with stock compensation expense? Well, with all expenses, revenues, and dividends, they're going to be closed out to retained earnings. So the impact of this is that I'm really, as a result of issuing stock options, I'm decreasing their retained earnings, increasing additional paid-in capital common stock. Again, think about this. This is not costing the company anything. By the way, before I go any further, I would never advocate for a company to go through and to not follow the rules put forth by the FASB or by the Securities and Exchange Commission. The whole point of this presentation is to show you the impact that this has had on the financial statements of publicly traded companies. And if we look over here, Facebook, Meta Platforms. Facebook went public on May 18th, 2012. At the time of the initial public offering, their additional paid-in capital, this was unaudited, was about $11 billion. As of today, their additional paid-in capital is about $54 billion. Now, when an investor sees, right, when we're preparing financial statements, our biggest goal as CPAs is we're here for the investor. We're here for the borrower. So what's happened here? Why did this increase by 42 billion? Well, the crazy thing about this is that this was not as a result of Facebook going through and doing another IPO. They didn't get cash for this increase of $42 billion. Rather, what all of this has come from, and again, I'm making generalizations, has come from stock compensation expense. So stock compensation expense, if we assume that the difference between these two numbers is basically as a result of stock-based compensation, I think it's a pretty fair assumption. This is artificially, in my opinion, deflated their retained earnings by about $42 billion. If additional paid-in capital common stock should only represent when we receive cash for shares and I'm crediting additional paid-in capital common stock, that's what we kind of think what that means, then our retained earnings for Meta Platforms, Facebook, essentially this has made this much of a difference. So the retained earnings of Facebook, if you remove stock compensation expense, would be about $121 billion. Now, Facebook, or Meta Platforms, right? I'm always careful about saying Meta Platforms because I'm always thinking of Ron Artest, who took the name Meta World Peace. He's like the original, right? I'm surprised Ron, hopefully he's getting something out of Facebook or Meta Platforms. That should be a really good advertisement where you have Ron Artest saying, hey, you guys took my name. Oh, okay. Go get him, Ron. So right over here, first stock, or go ahead, go get them, Meta World Peace. Okay. So right over here, you have stockholders equity, right? Of this is what you're kind of going through and seeing. And when you look at this, this is really what I love about Facebook, right? So Facebook right here, Meta Platforms, or it's Facebook. Okay. So net income is 9.1 billion for the 3 months ended September 30th, 2021. But when you look at what they've done, and I really like this, they've said share-based compensation expense included in costs and expenses. So when you look at this, they're giving employees stock options. As a result of giving those employees stock options, that cost Facebook 2.3 billion. It didn't really cost them that much, but rather what it was is that they actually had to record 2.3 billion of basically of stock compensation expense. So their net income should actually be, if you didn't include that amount, about $2.3 billion higher. That's pretty significant. Again, if we're going with the assumption that when we have share-based compensation, it should not be going through and impacting, the financial statements. So because it's not, again, it doesn't cost a company money to issue a stock option. Again, I'm looking at it from a cash point. The other thing I would tell you is that you say, well, Bennett, really? It's a look at this right over here. So the value of a statement of cash flows is the most important value of a statement of cash flows is looking at the add backs to net income. So here you have net income for the 9 months ended to September 30th, 2021. Share-based compensation, 6.7 billion. So there we subtracted to get to this 29 billion, 6.7 billion of share-based compensation. It's a very significant amount. And again, I applaud Facebook for coming over here and, Facebook gets rallied from a financial statement perspective. I give mad props to the CFO for going through, or their support staff, it's usually the support staff, of going through and identifying these items, because this is not a cash-based item. If I'm really going through and analyzing this company, that's what I would want to go through and kind of take a look at. So again, when stock-based compensation happens, there's no cash being paid out. What ends up happening is I have an obligation to sell shares to those employees for that stock price. Once they vest in those shares, that's what I have to do. So so again, this is how much it's impacted Facebook if we were to remove it. So this is again, over time, this becomes really significant. And what I'm going to do is, as I'm looking at this, one of the other things I'm going to go through and do is take a look at Tesla and really kind of see where Tesla, how stock-based compensation has impacted them. So takeaways from this, okay? For my classes and when I teach this, when I teach financial statement analysis, I am having my students go through and look at this. What I think are a couple different options here, which should be done, is that I think you should have 2 different additional paid-in capitals. One that relates to IPO or offerings where we received cash, or APIC cash or common stock, cash, APIC non-cash, or other, something like that. Because as an investor, when I see additional paid-in capital, there is, there's a whole slew of, again, there's this, when I'm an investor and I'm looking at the financial statements, if I'm looking at Facebook and if I say, oh, additional paid-in capital, that means, oh, Facebook has raised 54 billion. That's farther from the truth. They only raised about 11 billion. So this overstatement, when they did their initial IPO back in, or actually it was probably like 10 billion, whatever it was. But this is so significantly overstated that if I'm an investor, it's very misleading. And again, we're here for the investor as accountants. The other thing that you could also potentially do is to eliminate stock compensation expense. Frankly, for myself, I wouldn't have an issue with this, but I know that it will never happen because they don't want to go through and do that. So that's probably not going to happen. If you did eliminate it, you'd have to go through and restate financial statements for a very long period of time. But what should really be done about stock option, what should really be done is that my advocation has always been for a capitalization table. What is a capitalization table? It's a tool where the investor can determine how they're going to be diluted. What other options or other things are out there where I will lose my ownership interest? Is there convertible debt? Is there, if I'm private, is there convertible preferred? If I'm, is there stock options out there? Are there, what are those different, what's that capitalization table look like? That I think would be a very, very good thing to have in the financial statements. By the way, that idea did not come from me. I was once presenting to an investor, and that investor told me, he said, yeah, dude, put in a capitalization table because I have to go through and make up my own based on the public filings. And this is really why is that capitalization table so important, is because a common investor question, especially with a more of a startup type of company, is that how are they going to be diluted upon investing in the company? How am I going to lose my ownership of, of the shares? So again, this is something that when you're going through and analyzing publicly traded companies, privately held companies, you want to really consider that impact of stock compensation expense when you're going through and making your analysis. So this is something that is, to me, just artificially deflated the financial statements of a lot of different public companies. The biggest hit has been on tech companies. So again, I want to thank you for joining me on this presentation here today. If you have any questions, feel free to ask them in the comments. This is my email address. And please don't forget to like and subscribe. I'm actually almost at 1,000 subscribers. Once I get to 1,000, I'm going to be contacting some of the CPA review courses and see if I can do some giveaways of some CPA review products. But I look forward, though, to seeing you on the next video, and have a great rest of your day. Have a good one.